What happens if you take $10,000, put 60% into TQQQ, the triple leveraged NASDAQ 100 ETF, put the other 40% into TMF, triple leveraged long-term treasuries, and then just keep rebalancing back to 60-40, all the way from TQQQ's launch in February 2010 to today? No hindsight tricks, no simulated data, real market returns only, with dividends reinvested, from February 2010 through the end of June 2026. 16.5 years that include a zero-rate bull market, a pandemic crash, the fastest rate hiking cycle in 40 years, and everything in between. Today we'll find out what that $10,000 became, how it compares to simply buying the S&P 500 or the NASDAQ 100, how deep the drawdowns went, and how this strategy behaved in bull, bear, and flat markets. Quick reminder before we start, this is educational content, not investment advice. Leveraged ETFs can lose most of their value, and in this video, you'll see exactly how that looks. Let's meet the two players. TQQQ, our 60%, is the ProShares Ultra Pro QQQ. It targets 3 times the daily return of the NASDAQ 100, charges 0.95% a year, and launched on February 9, 2010. It's the growth engine of this portfolio, and, as you'll see, occasionally the wrecking ball. TMF, our 40%, is the Direction Daily 20-plus year Treasury Bull 3X, 3 times the daily move of long-term U.S. Treasuries. This is meant to be the crash hedge. Historically, when stocks panic, money floods into treasuries, and TMF triples that move. The third ingredient is the discipline, rebalancing back to 60-40. Every rebalance forces you to sell whichever fund ran up and buy whichever fell behind. Systematic buy low, sell high. And why pair them at all? Because a daily 3X fund suffers from volatility drag. In choppy sideways markets, it bleeds value even when the index goes nowhere. A negatively correlated hedge plus disciplined rebalancing is the only thing that makes a 3X fund even arguably holdable long-term. One slide on methodology, because I promised real data and I want to be precise about it. All returns are total returns with dividends reinvested. Annual returns for TQQQ, TMF, SEPY, and QQQ come from total real returns, which uses exchange quality data. Monthly returns come from Portfolios Lab, and 2026 year-to-date numbers are cross-checked against Yahoo Finance. Nothing is simulated or extrapolated. The window runs from TQQQ's first trading data in February 2010 through late June 2026. One honest footnote. For 2010, TQQQ's return starts at its February 11th inception, while the other funds use the full calendar year, a small stub period difference that I disclose rather than hide. On rebalancing, for the full 16-year run, the portfolio is rebalanced back to 60-40 at every year-end, because that's the granularity of publicly verifiable data for both funds across the whole period. For 2021 through 2024, where true monthly data exists for both funds, I also ran an exact month-by-month rebalance simulation, and we'll compare the two directly. Finally, what's excluded? Commissions, spreads, slippage, and taxes. Rebalancing 3X funds in a taxable account generates real short-term capital gains, so treat these results as a tax-sheltered ceiling, not a guarantee. Here's the headline. $10,000 in the 60-40 TQQQ TMF portfolio, rebalanced since February 2010, is worth roughly $592,000 by the end of June 2026. That's a gain of about 5,800%, a compound annual return of roughly 28% per year for 16.5 years. Compare the benchmarks. The same $10,000 in QQQ, the plain NASDAQ 100 ETF, grew to about $186,000, up 1,700%. In SPY, the S&P 500, about $89,800, up almost 800%. And here's the uncomfortable one. $10,000 in TQQQ alone, no hedge, no rebalancing, is worth about $3.5 million. 43% a year. So why bother with TMF at all? Because pure TQQQ fell 81.7% in 2022 and almost 70% in the COVID crash. The 60-40 version is the one a human being could conceivably hold, although, as the next slides show, even it demanded a stomach of steel. Here's the whole journey on one chart. Year-end values for the strategy, QQQ and SPY. Watch the shape of the teal line. It grinds higher through the 2010s, explodes through 2019, 2020, and 2021, and peaks at $682,000 at the end of 2021. Then 2022 happens, and the line collapses to $160,000. 3/4 of the portfolio, gone in 12 months. From there, the 2023 and 2024 recovery is just as dramatic, and by 2026, the strategy is at new highs near $592,000. Notice I left pure TQQQ off this chart on purpose. At $3.5 million, it would flatten every other line into the floor. And notice one more thing. For the entire stretch from 2022 into 2024, the boring orange QQQ line was not far behind the strategy, with a fraction of the pain. Let's put every single year on the table, literally. A few rows worth pausing on. 2011. The S&P was basically flat at plus 1.9, but the strategy made 38.8%. TMF returned 109% that year during the U.S. debt downgrade panic. 2013 and 2014 back-to-back, plus 68 and plus 73. 2017, plus 79.9. 2019, plus 94. 2023, the single best year at plus 113.6. Now the red rows. 2018, minus 16.3. And 2022, minus 76.5%. TQQQ down 79. TMF down 72.6, nowhere to hide. 16 full years plus 2026 year to date. 11 strongly positive, 3 roughly flat, 2 negative. But one of those negatives was catastrophic. Time to talk about the number that defines this strategy. Maximum drawdown. The big one is 2022. From the December 2021 peak of 682,000 to the December 2022 trough of 160,000, minus 76% on month-end values. And intra-month, it was deeper still. The portfolio didn't reclaim its 2021 high until 2026. That's roughly 4 years underwater. Put yourself there emotionally. You had $250,000. A year later, you have 160,000, and no guarantee it comes back. The episode table on the right adds context. In the COVID crash, TQQQ fell almost 70% in a month, but TMF spiked, and the portfolio recovered by July 2020. The hedge did its job. Late 2018, TQQQ down 58% peak to trough, but TMF rallied, and the year ended at only minus 16. The 2025 sell-off took TQQQ down 58% again before an August recovery. And the sleeper statistic, TMF itself, the so-called safe leg, has fallen 92.6% from its March 2020 peak and still sits near those lows. The hedge is, on its own, one of the worst-performing funds of the decade. Now the part you asked for. True monthly rebalancing, computed month by month from real monthly returns, over the most brutal stretch, January 2021 through November 2024. $10,000 invested in January 2021 grows to $13,400 by the end of 2021. Then 2022 destroys it, minus 75.5% for the year, down to $3,300. The worst single months tell the story. April 2022 minus 33%, September 2022 minus 28%, January 2022 minus 20%. Then the whiplash. 2023 delivers plus 87%, with monster months like November 2023 at plus 32%, and January 2023 at plus 28%. 2024 adds another 22.5%. And after all that, after a plus 87% year, the portfolio still sits at $7,500 in November 2024. 4 years of monthly discipline, and you're down 25%. That's what a minus 76% drawdown does to the math. After losing 3 quarters, you need a 300% gain just to break even. Let's organize 16 years into 3 regimes. Bull markets first. This is where the strategy is astonishing. 6 separate years above, plus 65%. 2013, 2014, 2017, 2019, 2020, and 2023 at 113. Leverage, plus a trending market, is rocket fuel. Flat and choppy markets are more nuanced. 2011 is the hedge's showcase year. Stocks flat, treasuries soaring, portfolio up 39%. But 2015 and 2016 show the other face. Grinding, directionless markets, where volatility drag ate the leverage, and the strategy returned just 5 to 6%, while plain SPY did 12 in 2016. Bear markets. 2018's rate scare cost 16%. Painful but survivable, because TMF rallied into the December panic. The strategy handles classic, deflationary, flight-to-safety bear markets. What it cannot handle is the 2022 regime, inflation-driven selling, where stocks and long bonds crash together. That's the one scenario this structure has no answer for. Let's slow down on 2022, because it's the whole risk lesson in 1 year. The NASDAQ 100 fell about a third. Daily 3x compounding turned that into minus 79% for TQQQ. Normally, that's exactly when your treasury hedge saves you. But 2022 wasn't a growth scare. It was an inflation shock. The Fed hiked at the fastest pace in 4 decades. Long bond yields exploded, and TMF fell 72.6%. The two assets that were supposed to offset each other moved together almost all year. So the 60-40 finished at minus 76.5%. And notice something cruel about the mechanics. Every rebalance that year sold the fund that was falling slower to buy the fund that was falling faster. The discipline that creates the rebalancing bonus in normal times became a machine for averaging down into 2 crashes at once. The lesson: TQQQT-TMF is not a market-proof machine. It is a leveraged bet that stock-bond correlation stays negative. When that assumption breaks, the strategy breaks with it, times 3. To be fair to TMF, let's look at its greatest moment, 2011. That summer brought the U.S. debt ceiling crisis, the S&P downgrade of U.S. credit, and the European debt panic. Equities chopped violently and finished the year flat, SPY up just 1.9%. TQQQ actually lost 8% that year, a perfect demonstration of volatility drag, losing money while its index went nowhere. But investors stampeded into treasuries, and TMF returned 109%. Run the math. 60% times minus 8, plus 40% times plus 109, gives you roughly plus 39%, in a year when stock investors earn nothing. That's the case for the 40% sleeve. In risk-off flat markets, TMF isn't deadweight. It's the entire return engine. The strategy's edge has always come from these violent flights to safety. Here's a question almost nobody tests honestly. Does rebalancing monthly actually help? We can answer it with real data for 2021 through 2024, using identical monthly returns for both versions. Rebalancing every month turned $10,000 into about $7,500. Rebalancing just once a year, letting the weights drift in between, ended at about $9,100. Monthly discipline lost roughly $1,500 more. Why? 2022 again. Every month end, the monthly rule sold whichever fund had fallen less, and shoveled the proceeds into whichever was falling faster. 12 rebalances into a twin crash is 12 rounds of catching falling knives. To be balanced. In whipsaw recoveries like 2020 and 2023, frequent rebalancing genuinely harvests volatility between negatively correlated assets. That's the theoretical rebalancing bonus, and it's real. The honest conclusion: rebalancing frequency is a second-order effect. The first-order question is correlation regime. No calendar rule rescues a triple leverage portfolio when stocks and bonds fall together. 4 takeaways from 16 years of real data. 1. The strategy genuinely crushed the indexes over the full run, 10,000 to roughly 592,000, 28% a year, versus 186 for QQQ and 90,000 for SPY. The concept works, over a period that happened to be historically kind to US tech. 2. The price of admission is watching 3 of every $4 vanish. Minus 76% in 2022, 4 years underwater, plus separate 58% drawdowns in 2018 and 2025. If you would have sold at the bottom, and most people would, the backtest doesn't apply to you. 3. Know exactly what your hedge protects against. TMF cushions deflationary panics, 2011, 2018, 2020. It amplifies inflation shocks, 2022. And on its own, it remains down about 92% from its 2020 peak. 4. If this belongs anywhere, it's as a small satellite position, not a portfolio. These numbers exclude taxes and costs, and monthly rebalancing in a taxable account is tax inefficient. Size it so a 76% drawdown is an annoyance, not a life event. Everything in this video is verifiable. Annual total returns, growth of 10,000 figures, and drawdowns come from total real returns. Monthly returns from Portfolios Lab, 2026 year-to-date figures cross-checked with Yahoo Finance and Stock Analysis, fund facts from ProShares and Direction. All figures are total returns with dividends reinvested, as of mid to late June 2026 depending on the series, and the exact as-of dates are on screen. One final time. This is education, not advice. Leveraged ETFs reset daily, behave very differently from their indexes over long periods, and can lose substantially all of their value. If this deep dive helped you understand what triple leverage really costs, and really pays, hit like, subscribe to Ascent Financial Wealth, and drop a comment. Could you have held through 2022? I'll see you in the next one.